Good day and welcome to the fifth installment on this lecture series on business funding and how to get business funding. My name is Doyle Roberts and I'm your presenter for today. And the topic that we're going to discuss today is how to get funding through private placement memorandums, also known as PPMs. In terms of all of the funding methodologies and the strategies that we've made mention to earlier in terms of angel investor funding, in terms of venture capital funding, in terms of all of the methods that we've alluded to earlier, I would say that private placement memorandum, private placements are the best and the fastest and the surest way to obtain funding in an environment that is conducive to success. In terms of the different regulations that the SEC has presented to the world, we find that they've made allowances for what they call Regulation S and Regulation D. I'll just make subtle references to Regulation S, but the primary focus of this lecture will be on Regulation D, private placements. What we find is raising capital for small businesses can utilize SEC Regulation S, which would enable them to locate accredited investors using general solicitation and advertising. In addition, a small business can also utilize mailing lists and pay finder's fee to non-broker dealers. On the other hand, different from Regulation S, a small business can also utilize Regulation D to offer a private placement of securities to U.S. investors as well. By combining both a U.S. private placement offering and a foreign direct public offering, the small business has a broader chance of raising the required capital that it needs. And this is the fundamental reason why I tend to advise most of my clients to try a Regulation D offering before other methods are put into place. In terms of the three variants or the three different types of Regulation D offerings, the D series is broken down into three categories: the 504, the 505, and the 506. Underneath the 504 regulation, you can raise up to $1 million and have unlimited number of non-accredited investors. I'll say that again. Underneath Rule 504, you can raise up to $1 million and have unlimited number of non-accredited investors. The next one, Regulation D 505, you can raise up to $5 million and have unlimited number of accredited investors. I'll say that again. Under 505, you can raise up to $5 million and have unlimited number of accredited investors. The third Regulation D regulation is 506. Underneath this, you can raise an unlimited amount. An unlimited number of accredited investors can be brought in as well. So we have these three parameters. You have the 1 million range, you have the 5 million range, and you have the unlimited range. And based on what your business is going to require, that will dictate which placement you would wish to pursue. Generally, to raise capital, a company must register its stock or securities with the Federal Securities and Exchange Commission, or the SEC, and with each state that they're going to be operating out of. Registration typically involves providing and obtaining approval from the federal and state governments for complex information about a company and its financing. What we find is that registration is sometimes time-consuming and expensive. Most registration exemptions limit the number of investors, the dollar amount of the offering, and the manner in which money may be raised. The most common exemption from registration is the private offering. and private offerings are generally sold through a legal disclosure document known as a private placement memorandum. Although private offerings are exempt from federal and state registration requirements, complex notice filing requirements still exist, and many states further qualify a private offering. Not all states have one consistent method of raising funds in this way. Excuse me. Finally, private offerings may not be sold by means of general advertising or solicitation. This is one of the key areas problematic for some and grave for others. Normally, a pre-existing relationship between the company and the investor is required. Most entrepreneurs do not know enough qualified investors to finance a private offering. It is therefore easy to inadvertently turn a private offering into a public one, which then defeats the exemption and requires registration and or return of the investor's money. What we find is that the SEC has created a safe harbor per se. This safe harbor guideline is to enable companies to stay within the private offering exemption. Regulation D 17 CFR section 230 under Rule 506, it allows a company to sell an unlimited dollar amount of securities to an unlimited number of accredited, generally wealthy investors and institutions. This can be clarified. You can see it more clearly in Rule 501. Investors and to up to, say, 35 non-accredited investors. While Regulation D provides burdensome disclosure requirements for offerings over 7.5 million, such as expensive and time-consuming audited financial statements, these requirements are lessened if the offering is limited to accredited investors only. Regulation D offerings must still comply with state exemptions, filings, and qualification requirements that I alluded to. These requirements or filings are known as they come under what is known as the blue sky laws for that state. However, Rule 506 offerings are not subject to burdensome state qualifications, only to state notice filings and fee requirements. For emerging as well as many established companies, the best way to raise capital is through a Regulation D, Rule 506 offering, limited to accredited investors. The only remaining problem is Regulation D's prohibition in terms of solicitations and advertisement. But overall, the Regulation D platform is a great platform for you to raise funds through. I alluded to the Regulation S regulation earlier. What this is this covers foreign direct. This covers the foreign direct offerings, and it can help you raise money for your business by soliciting investors in other countries and other jurisdictions. This regulation is an exemption designed by the SEC for companies seeking to like I said, raise capital from investors outside of the U.S. You can solicit capital from non-U.S. investors through general advertising and general solicitation. Yes, I said it, you can solicit them via that route. Unlike the restrictions imposed by the Regulation D, a U.S. company or any person acting on its behalf seeking to raise capital utilizing Regulation S exemption may, 1, use any form of non-U.S. general solicitation or general advertising. 2, they can use foreign investor direct mailing lists. 3, they can pay non-U.S. finders fees. And 4, they can place tombstone ads in foreign magazines and newspapers. So basically, ladies and gentlemen, based on what you're looking at, if you know that your general investor base is going to be in the U.S., I would advise you to go along a Regulation D path for your private placement. But if you're looking to raise money internationally in terms of the European and the Asian markets, you can use the Regulation S, and this would cover you quite comfortably. Now, as we move along and we look closely at how you raise capital with a private placement memorandum, what we see is that when you're raising capital, occasionally investors will want their equity distribution in an SEC recognized format, like this a private placement memorandum. This structure makes use of one of the 3 Regulation D exemptions, as I alluded to earlier. Now, why are these rules important? Well, these rules carry different criteria that helps businesses raise equity funding without all the stringent legalities of an IPO. This is the primary reason for using the Regulation D rounds. These rules are defined like this. Rule 506 provides an exemption for limited offers and sales without regard to the dollar amount of the offering. This exemption does not limit the number of accredited investors. So if you're looking at raising, say, $50 million, this may be the path that you may want to take. But you should also remember that all non-accredited purchases, either alone or together with a designated representative, must be sophisticated enough. That is, they should have the knowledge and the experience necessary to evaluate the merits and the risk of the investment. An offering company typically determines the sophistication of its investors with a questionnaire subscription agreement. Rule 506 requires detailed disclosure of relevant information to potential investors. The extent of disclosure depends on the dollar size of the offering. What I find is Rule 505 offerings may not exceed $5 million in terms of fundraising. So this is the midline. As well as this exemption limits the number of non-accredited investors to 35. So you basically have to chart your course in terms of carefully considering what exactly your company needs in terms of funding, the specific amounts, and this will determine which regulation you'll want to make your placement with. The vast majority of businesses, they fail to raise capital because they lack the proper documentation when it comes to private placement offerings, or because their documentation, or their business plans, their private placement memorandum, their investor presentations are inadequate, unprofessional, or simply unpersuasive. If you are raising investment capital from multiple angel investors, a private placement memorandum is a necessary part of your documentation. As important as the PPM is in the process, most entrepreneurs aren't familiar with how to prepare and market private offerings. In too many instances, this lack of knowledge prevents business owners from raising the necessary capital that they need. And if you run afoul or you break the SEC regulations, you can even end up with costly legal liability problems. There are 3 common questions that are regarding private placement that normally comes up. The first question normally is, when do you need a private placement memorandum to raise capital? And the answer to that is, it's necessary when you are raising private investment from multiple private investors. It is specifically suited for this purpose because it explains the structure and the terms of the investment, as well as protecting the seller from liabilities associated with selling unregistered securities. The second question that normally comes up is, how do you market a private offering if you can't solicit and advertise in the traditional sense of the other types of general public offerings? Well, the answer to that is, excuse me. The key to marketing a private placement offering is to retain Regulation D exemption, which allows business owners to sell privately traded unregistered securities to investors. Let's start off by examining how you cannot market a private offering. You can't market a private offering in public advertisements such as TV, radio, or the newspaper or other print media, because these types of marketing messages constitute general solicitation. If you make general solicitations, your offering is no longer a private offering. You have created a public offering, and as a result, you no longer qualify for the Regulation D exemption. Instead of publicly advertising an offering, you are required to market to investors with whom you or your intermediaries have a previous business relationship. The next question that normally comes up is, what are your options for preparing a private placement memorandum? Well, that is simple. You can either, one, develop it yourself using templates. Two, you can hire a securities attorney or law firm to drive to draft up the PPM. Third, you can hire a firm like Wilson and Roberts that specializes in PPM development. The advantage of doing it yourself is obvious. You save money. If you are intimately familiar with the process of developing a PPM, this is your best option if you're financially strapped or you're trying to cut down costs. But if you are unfamiliar with private placements, this is a very unwise place to cut costs. It is very possible that you will undermine your own fundraising efforts as well as open up yourself to legal liability. The advantage of hiring a qualified securities attorney is that you know you are in good hands legally. If you have the resources, some attorneys will charge as much as $75,000 US. This is considered perfectly acceptable in the arena of business. However, for many emerging business owners, the cost of having a securities attorney, especially from a large reputable law firm, to draft your PPM can be rather expensive. A third option, as I mentioned earlier, is you can hire a firm like Wilson and Roberts that specializes in private placement memorandum development and then have the PPM reviewed by a securities attorney. While not nearly as cheap as writing the private placement yourself, this approach affords some cost savings while meanwhile providing you with a professional document that will maximize your chances of raising the capital you need to grow your business. On average, firms of this nature charge anywhere between $30,000 and $50,000 for this particular service. So, if you're now moving into the realm of raising capital with private placements, programs, and platforms for any business, you must realize that times are changing in the world of business finance. The reality is no longer commercial bank loans the only way to finance a business. In today's modern business environment, any entrepreneur can raise capital with private placement programs and platforms. Private capital is available to any entrepreneur with any size of business, small, medium, or large. Because of the Regulation D offerings, many small businesses are now aware of private capital that few did not have access to before. Although many small business owners are aware of private capital, few have the resources to locate private investors, and few possess the upfront capital to pay the professionals the required fees to design and develop the investment documents. Developing an investment offering typically requires an attorney and other professionals who specialize in private placements. Everyone knows that most entrepreneurs have limited capital when starting a business. Prior to, say, 2002, private capital was extremely expensive. The capital itself was not necessarily the most expensive item, but the preparation costs were over the top expensive. Entrepreneurs needed a selling document that was vetted by legal experts and consultants. This selling document, or the private placement memorandum, was what was so expensive prior to that period. Because this document provides details for every aspect of the business and the investment being sought. What we find is in the earlier days, say pre-2000, Private placement memorandum development started at 15,000 and went as high as 50,000. These prices are still around, still found today in more specialized areas such as hedge funds and public offerings. However, a few savvy entrepreneurs have narrowed this price margin substantially over the last 8 to 9 years, bringing the prices down to manageable costs. So you can keep that in mind. In terms of qualifying for Regulation D, nearly all companies right off the bat qualify for Regulation D. That would be any business or startup, hedge funds, large public corporations, mid-sized companies, foreign corporations, you name it. Literally any type of company can qualify for a Regulation D private placement. The prerequisites include, but are not limited to, the 6 things. The 6 prerequisites that you need to be mindful of are: 1, the selling document or the private placement memorandum itself. 2, a Form D filing at the SEC. There's no filing fee for that. 3, a state filing in whatever state the company raises private capital. There is a small filing fee with that, and it varies from state to state. 4, no soliciting to investors. And 5, the securities are sold as restricted from transfer or trading for 12 months. So keep that in mind as well. Lastly, 6, the amounts of capital raised must adhere to one of the Regulation D rules, whether it's 504, 505, and 506. And just to remind you again, 504 up to 1 million, 505 up to 5 million, 506 unlimited amount of fundraising capacity. What we find is throughout the history of business cycles in the U.S., the typical avenue for business financing has required long bank applications, expensive business plans, or SBA involvement. Thanks to a handful of financial visionaries, private capital is making a comeback into this process, and that is the reason for the resurgence of the PPM method of raising funding. In terms of getting the investors you need through your private placement, you need to gain the confidence and capital of accredited investors without soliciting, and this in itself can be difficult because if you don't know how to communicate with your investors, the document, your PPM, becomes a worthless document that you can't solicit investment capital for. So whenever you decide that you're going to prepare the document, first make sure that you know you find that you'll eventually need to make your way to an actual PPM author, not a broker, so that you can get a PPM that protects you from lawsuits and gives the investor a real breakdown of the upside and downside of your business. Next, you'll need to find an investor finder. Yes, this is an actual term for an individual or corporate entity that is completely submerged in the accreditor investor realm and is able to match your opportunity with friends that he or she has in their database of real accredited investors. This is the second half of the PPM equation. Don't fool yourself and don't allow yourself to be lied to. You're going to need a seasoned professional to help introduce you to investors that have the capital to help you get to where you need to be. Friends, family, and employees will commit to investing in your company until your PPM is completed and it's time to make good on their commitment. All of a sudden, they have all kinds of excuses and no money comes forward. With a real private placement memorandum and a solid investor finder, your problems are basically over. I'll say that again. With a real private placement memorandum and a solid investor finder, your problems are basically over. I tell you to investigate where the author and the investor finder stand in the internet public domain, and after you find a company that meets your needs, get moving and start raising capital. I would recommend that you do your due diligence on whoever you decide to do business with. In terms of understanding the basics of Regulation D, I want to break that down even further, because many would hear me saying Regulation D, and and these 504 numbers and 505s and 506, and they're not really clear as to what it really is. Regulation D Basics or Regulation D Basics refer to the SEC program that gives companies an opportunity to raise capital without SEC securities registration, and to raise capital by selling equity in their firm or through debt securities, private or public issue of stock. One could raise capital by adhering to the three fundamental rules of 504, 505, and 506. Each of these rules caters to a certain amount of capital, as I alluded to earlier, and is targeted towards a different type of investor market. The entire offer is conducted in different ways too. Each of the Regulation D Basics has a specific private placement memorandum, and based on that, one can either go in for getting an attorney drafted customized PPM written, or go in for buying a private placement memorandum template. As raising capital is not an everyday job, many entrepreneurs are unable to do it on their own and go in for the services of a private placement memorandum consultant, or buy a private placement memorandum template. The entire private placement memorandum template should reflect a structured and professional transaction. If otherwise, it gives an unprofessional picture of the future to the future investors. One could raise up to $1 million under Rule 504, up to $5 million under Rule 505, and any amount under Rule 506. Therefore, one has to be meticulous about the pre-offering framework, which is the first step in preparing a Regulation D offering. Once the type of Regulation D program to be employed is finalized, one can go ahead with the document creation. It is here that the private placement memorandum comes into picture and discloses the pertinent information to all the potential investors regarding the company and its proposed operations and intentions, along with details regarding the risk factors. Once the offering is professionally drafted, it is ready to be revealed to potential investors. The Regulation D programs can be made use of by domestic and foreign corporations too. I'll say that again, it's rather important. The Regulation D programs can be made use of by domestic and foreign corporations too. A thorough understanding of Regulation D Basics will help one to identify the right program that would suit their business, as well as gives them an insight into the two types of Regulation D offerings, equity and debt, and helps them decide the perfect one for their business. Okay, in terms of giving you a working example, say for instance you and your group, you want to do say a land development deal for say a 18-hole golf course hotel development. There are 6 steps that you should keep in mind when establishing a group investment partnership, in terms of getting it funded, and in terms of bringing it to a successful conclusion. If you follow the 6 steps process to set up your group investment partnership, you should have success. This process covers critical functions a sponsor needs to complete to be successful. The first step is to prepare the private placement memorandum, prepare the PPM. In preparing this extensive document, the sponsor should engage the assistance of qualified legal counsel to make sure the document is properly put together. If you are syndicating your first group investment, then I highly recommend you obtain the guidance from local legal counsel. And because if it's a land development deal, as I alluded to earlier, you'll be operating under the Regulation D 506 rule for an unlimited amount in your raising process. The second step would be to prepare the offering circular. This is to help expedite the marketing program. The sponsor should prepare a simple 1 to 4 page brochure that includes the facts on the proposed offering. The third step you should take is to obtain securities clearance. Federal and state law clearance or registration must be complete before offering securities to investors. Each of the 50 states has different rules and regulation governing the sale of real estate securities in this instance. So you must be mindful of that. Fortunately, I should say, many types of securities and many transactions and securities are exempt from state securities registration requirements. For example, many states provide for transactional exemptions for Regulation D private offerings, provided there is full compliance with SEC rules 501 through 503 in terms of the nature of the investors, whether accredited or not, and other stipulations that you should be mindful of. However, though certain types of offerings or transactions may not require registration, many states require filings or place additional conditions on exemptions available for many different offerings for which exemptions are available. The best advice then is, before offering any security for sale in any state, experienced counsel should be retained to review the applicable state laws and take any action necessary to permit the offering to be made in the particular state. The fourth step is market the offering to potential investors. Now that your PPM is complete and is in compliance with state and federal security law regulation, you can market your investment opportunity to potential investors. Take the list of potential investors you have created and send your PPM to them. Since the PPM is confidential, make sure only the intended potential investor reads the contents. Finally, make a detailed record of all the potential investors that have received your private placement memorandum. Fifth, you review the investor subscription package. As the LLC member interests are sold, each investor should send a copy of the subscription booklet and check for the member interest purchase. The sponsor should carefully review the subscription booklet to make sure that all the requested information is completed and that the investor meets the suitability requirements of the transaction. If any of the information is not correct, the sponsor should notify the investor to correct the information, or notify the investor that they do not meet the suitability requirements. After a careful review of this package, the sponsor should sign off on the various documents in this package. Step number 6 is you should set up an escrow account for the initial contributions. Prior to any investor contributions being collected, the sponsor should set up an escrow account with a local bank. The bank should have a set of the instructions as to how and when to break escrow and to distribute these collected funds. Another way to handle step number 6 is to have each investor send money directly to the real estate escrow account. All of the money from the investors will be in the escrow account for closing of the investment property. Normally, from all the money sent to escrow from the investors, there will always be excess funds after closing. The escrow or title company will send the new buyer, the investment group LLC, the balance of the funds. Take this check and deposit it into the new LLC partnership account. This partnership account will be used to operate the partnership until the property is eventually sold. And that is the 6-step process that you'll need to take in putting your deal together from start to finish. If you're looking at investing in private placement in terms of what is involved in it, you should know that these are a certain kind of investment that is only made available to a select group of private investors. They are invited to invest in a business instead of the business making the offer available on the whole market. The investment could be in the form of a warrant, preferred or common stock, or promissory note. The biggest difference between investing in these placements and regular investments is that private placement investments are not required to be registered with the SEC or the Securities and Exchange Commission. This prevents these kinds of investments from needing to hold fast to firm rules that regular investments must. The reason why some businesses prefer to offer opportunities for investors wanting to invest in this kind of placements is because they do not need to disclose very much information to the public about their company if they do not want to. That's the bottom line. Of course, there are other requirements that must be met for an investment opportunity to be qualified as a placement of this type. For example, potential investors must be told about all applicable information so they can make an informed decision about investing in these placements. There's a high degree of risk associated with investing in these placements for several reasons. For example, since securities are not publicly traded, they are less liquid. Plus, sometimes investors are required to hold on to stock for a certain amount of time before trading. Another reason is that companies looking for these investors are typically in the early stages of development because they have not had their initial public offering. This means they are fresh on the market and have not proven themselves yet. Therefore, if you are serious about investing in these placements, you must be aware of low liquidity, have a high risk tolerance, and be prepared for the long-term commitment that will be required of you. You can improve your chances of success with this kind of investment by conducting independent research. Ensure that your due diligence is competent. You should see how a company promotes itself in the PPM or private placement memorandum. There will also usually be an investment bank acting as an intermediary between the company and future investors. You can support a new business looking for opportunities to make money without going public by investing in private placements. You stand to gain a large return on your investment if you are willing to devote enough time and effort to the private placement. In conclusion, there are a few elements to fundraising that private placement memorandum specialists normally would leave out of the conversation when they're lobbying a potential client. And these key areas that they tend to leave out are the due diligence, the necessary, one, due diligence, two, necessary mass publicity, and three, executive industry status and industry position of the company trying to raise funds. And without these three elements taken care of during the PPM process, your PPM would be completely worthless. I'd say that again. Those three elements that I'm talking about, I'll name them again. One, due diligence. Two, necessary mass publicity. And three, executive industry status and industry position of the company trying to raise funds. Investors in this economy are being more conservative with their, I shouldn't even say conservative, they're being more ferocious with their due diligence research than ever. And the reality is for angel investors and private investors, a lot of it, if not most of it, the due diligence takes place using major search engines after the basic background checks are completed on the executive staff and majority shareholders of the company. A company that writes private placement memorandums without the publicity and due diligence campaign is setting the client up for absolute failure. I'll say that again. A company that writes private placement memorandums without the publicity and due diligence campaign is setting the client up for absolute failure. When you are pre-qualifying a company that writes a private placement memorandum, there are a few questions you'll need to include after you qualify their ability to author a complete private placement memorandum for your company. And those questions are: one, what do you do after the PPM is written to help me raise capital? Two, what do you do to help my company pass due diligence that will make or break my deal with the funding source? Three, what do you do to place my company and executive staff on the map as industry leaders to create instant comfort and connection with the investment source? Four, how do you assist me in ongoing publicity, marketing that is absolutely crucial to helping me stand out to the potential investors? These are the questions that you must have lined up and ready to go. These services must be included with your PPM because it's the only way to promote the company without breaking solicitation laws set forth in SEC guidelines for Regulation D. When getting a PPM written to raise funds for your company, you must have a complete package or your fundraising efforts will be shut down before they even get started. So with this in mind, yes, private placement memorandums are the best means of raising funding through angel investors and venture capital and large private equity groups. But the thing is, you must be mindful of the solicitation and advertising rules in terms of the time frame that you can look at. On average, raising funds takes anywhere between 3 and 6 months. In terms of private placements, in organizing those funds, you'll have up to a year to conclude your funding program. So these are the types of things that you need to be mindful of. If you need assistance with putting together your investment package, your private placement packaging, your due diligence package, and so on and so forth, your publicity packaging, we at Wilson & Roberts, we can assist you in this. I hope this has been very informative for you. This is Doyle Roberts signing out from wilsonandroberts.com, hoping you great success and great fortune in your fundraising activities. Have a great one. Good day.